Adam Kobeissi joins us. We got a very big response during the last time he was here. Young guy, very young guy. But if you go to his website, and he's been investing. It's been a hobby since he was 12 years old. So he's actually quite an old guy doing this. So Adam, very good to have you. Let me get your take on how Susan was sort of outlining where we stand right now. It's been a bumpy start to the new year. We could probably expect a lot of that, but what do you expect?
Yeah, I mean, we had one of the most historic last 2 months of 2023 ever. The S&P basically tripled its year-to-date return in the first 10 months in the last two. So now we're seeing some profit taking, and I think a lot of this was based on, is the Fed going to pivot? That's really what the question has been. And it seems like the Fed did pivot in December, but the market's pivoted even more than the Fed pivoted. So the Fed's been guiding 3 rate cuts now in 24. The market's seeing anywhere from 6 to 8 with a median of about 150 bips expected. And I think right now we're seeing that these Fed expectations are kind of being realigned a little bit here. You can't have double the amount of rate cuts as the Fed. And actually, a lot of Fed members are coming out now saying, maybe we need another rate hike. I mean, this morning we saw that from a Fed official. And I think maybe just Fed Chair Powell's comments were taken a little bit too far in the dovish direction. You're seeing yields rise again today. You're seeing pressure on some of the risk on assets, tech, the Magnificent Seven. And I think it's warranted. This is something we've been kind of publishing for our subscribers. We got short gold. We got long Treasury yields over the last couple of weeks, and I think it's going to continue into mid-January.
All right, just a couple of things because you're an encyclopedia with this, but when you're referring to bips, of course, you're talking about basis points. The market's already factoring 150 or 1.5 full percentage points worth of cuts. And the Fed has only telegraphed about half that. So obviously the market's getting ahead of itself. Maybe the Fed will hint at that in the minutes that are released from the last December meeting. But to your point, the Richmond Federal Reserve President Tom Barkin was speaking in Raleigh, North Carolina at a Chamber of Commerce event where he said just what you said, that, there is no autopilot. He was saying it's time to buckle up. What do you think he meant?
Yeah, I mean, I think there's clearly some internal division at the Fed where some officials really want to see rate cuts come quicker. Some are in their camp of maybe we need to pause longer, and some are even in the camp of maybe we need to raise more. And right now, the market just keeps wanting to know when are rate cuts going to start. And he specifically said that speculating even into March, which is just a couple months out, is too far in advance to see. They want to see what's going to happen with inflation over the next couple of readings. And I just think that the Fed is trying to manage market expectations because even as we finally got the quote-unquote Fed pivot, it's a reminder that literally 1 month ago, Fed Chair Powell said it was premature to talk about rate cuts. So it just feels like things moved a little bit too far, too fast in the dovish direction, and now they're trying to backtrack a little bit. But obviously, interest rates are down a lot. The average 30-year mortgage is down 130 basis points in just over a month. It's tough right now for the Fed to kind of manage expectations. I think that's what they're trying to do.
Well, the market did get ahead of itself, and maybe properly so. Maybe it'll be proven right. It's too early to say. But certainly even anything housing-related might have gotten ahead of itself. Home builder stocks have been soaring. We've been looking at this ETF, looking at the iShares U.S. home construction. That's essentially doubled over the last year. So what if the markets have it wrong, that these rate cuts, they might still be coming, but they might not come for well down the year? I mean, maybe in the second half of the year.
Yeah, I mean, I think that's exactly the situation. I think the timing of rate cuts is still up in the air. They could begin in March. They could begin in May. But I think the quantity of rate cuts has moved too far, too fast. I think 3 rate cuts like the Fed is guiding is a good base case. And I think that if that is the case, then we will see higher costs of capital going into 2025. I think the cost of capital is permanently higher. There's kind of this expectation that rates are going to come back down and then everything's golden again, we're good to go. It's not just about getting rates down and then we're good. It's more about where do you find that long-term rate, level of interest rates that can sustain the markets and also keep inflation around 2%, which is their long-term target. And they've also made it clear they're not going to change their target to 3%. It's 2%. So I think rates need to remain sufficiently restrictive for longer to get there. I mean, core inflation is still above 3%. And we're seeing a variety of headwinds that warrant the Fed keeping rates a little bit higher for longer. And also, it's worth noting, the Fed would rather keep rates higher for longer, for too long, than cut too soon and risk a
Absolutely.
resurgence of inflation, because that would just destroy consumer sentiment and also damage the reputation. So I think
that
they're
has
going to
happened
always play it
before.
safe
That
on
has
that
happened
front.
before where they jumped the gun and regret it. Adam, very good seeing you
Absolutely.
again. Happy New Year.
Happy New Year. Thanks for having me.